Hey guys, so because the market is crashing, I decided to do a no shave February so I can save some money on shaving cream. I'm joking, but on a serious note, we need to discuss the market and what you should do right now with your money. By the way, if you're new, my name's Henry. I'm an option trader and I have a passion for teaching and traveling. That's why my background keeps changing. And don't be a bear, be a rhino. I also speak Russian fluently like my brothers Andrei Jik and Tom Nash, and I trade options like a dude that needs to pay off an expensive Lambo that he rented. In other words, I've been doing it for 9 years, and because I have a finance degree from an elite university, I know exactly what's going to happen in the market. Well, no, not really. I still don't know. But I am going to show you plan B using simple options in this market. But first, let's discuss some important things. Like rule number 1, don't time the market. I know it's tempting, especially because rent prices are expected to increase a lot in 2022 and we all have bills to pay. In fact, Americans expect the average cost of rent will rise by some 10% this year, up to maybe even 15%. So with higher inflation, we need to have better returns in the market to keep up with those prices. So what do we make of this correction? Well, this exact situation happened in February 2020, exactly 2 years ago. The S&P 500 index fell into correction territory in the final days of February, closing more than 10% below its last all-time high reached earlier in the month. This year, so far, the S&P 500 is down, drumroll, 7.8%. So we're not just there on a correction, but I know people are experiencing pain and I feel the pullback myself, even though this is not a formal correction by definition at the moment. But the same article also says these market corrections are more common than you might think. In fact, the data says since 1974, the S&P 500 has risen an average of more than 8% 1 month after a market correction bottom and more than 24% 1 year later. As you can see in the chart, a decline of at least 10% occurred in 11 out of 20 years, or 55% of the time, with an average pullback of 15%. And in 2 additional years, the decline was just over 10%. Despite these pullbacks, however, the stocks rose in most years with positive returns in all but 5 years at an average gain of approximately 6%. It remains to be seen whether the recent market volatility has reached its bottom point, but if things get worse, the average pullback is about 15%, so we could see about 7% further decline in the general market. That means technology stocks and growth stocks will sell off harder than the rest, and safe stocks like the ones that have dividends will tend to fare a lot better. But that doesn't mean you should sell anything. That's because there's typically large recoveries after selling days. For instance, by staying fully invested over the past 15 years, you would have earned $24,753 more than someone who missed the market just 10 days. And those are the 10 best days, as you can see. Missing just 10 days in the market could significantly hurt your returns by about 50% over 50 years. You can also see what missing 20 days, 30 days, and 40 days does to your overall returns. The moral of the story is if you just stay invested, you're likely to see the highest returns in your portfolio long term. And by panicking or just trying to beat the market by selling, you risk the chance of doing the exact opposite. That's why the best thing to do is absolutely nothing. Just keep holding. Stay invested and keep the high quality stocks you have in your portfolio. You should cut stocks that you feel are not your long-term holdings because maybe you took on a little bit too much risk, or maybe you had some wishful thinking about a certain name, but the majority of your portfolio should not be touched. It's fine to cut a position you no longer want to hold, but don't cut the high quality stocks because of a short-term event. Now, this knowledge applies to stocks, but what could it do with options? Well, that's where things get even more interesting. You know I'm going to educate you right now. Remember how I said the average market pullback is 15%, but at the same time, markets typically rise fast after a big red day. Well, there's a few strategies that can make more sense than just stock investing. I want to teach you so you can have a plan B to every other boring buy and hold investing channel. I respect a lot of those channels, but what they say and what they do sometimes might seem a little bit off. Some days they're really bullish and some days they're really bearish, and they go from bullish to bearish very often. I mean, take a look at these thumbnails. I mean, they're pretty funny. Upcoming market collapse part 27 has already been predicted by many YouTube channels, and it seems there's always a huge market collapse just around the corner. Now, those type of videos do get clicks, but in reality, the stock market is completely random. You can't actually predict when a crash will happen or if a correction will become a further further correction. In fact, a famous book written by Burton Malkiel, I'll link below, talks about a theory called the random walk theory. Basically, a random walk means a stock has equal odds of rising or falling, so there isn't any way to predict what will actually happen, despite all of the research that you may do on inflation, mortgage rates, or what have you. This is why buying and holding is the best way for long-term gains, and there really isn't a point of picking stocks. Well, at least that's what the experts say. I'm not sure which way the market will go, but I can see a lot of volatility dragging the market much lower, or the market having another short-term U-shaped recovery like it tends to do over and over again. Now, I have a strategy for not knowing which way the market is going to go, but it's going to go big in one way or the other. Given this information, I want to talk about the VIX and a plan B strategy that you may want to implement with a small part of your portfolio. If you also see a lot of volatility coming, this is going to be pretty much the perfect plan for you. Here is the VIX. The VIX is known as a fear gauge. It's a real-time market index representing the market's expectations for volatility over the coming 30 days. So it's a forward-looking indicator or a forward-looking number. When the VIX goes higher, that means investors believe a lot of volatility will occur over the next 30 days. And vice versa, if it's low, that means they're not expecting much volatility. The VIX has been very tricky lately because in late January, it was trading as high as $32. It deceived everyone, including myself. It completely deceived me when just this past week, it was below $20 again. However, the VIX is rising again with inflation, rising mortgage rates, which just passed 4%, and tensions in Ukraine, where, by the way, I was just living there a couple months ago. And I can see the VIX going back above $30. Now, this is where I believe Plan B can come into play. Now, you can buy both calls and puts on the S&P 500. You can bet on a big rise or a big fall. Buying calls and puts at the same strike price, say for S&P 500 at $440, would be called a straddle. You're betting on both sides. You're betting for a big potential fall or a big potential rise. Now, here's an additional piece of information that you need to know about. My plan is not to actually hold these options until expiration. Say I go out 1 or 2 weeks out. Whenever I open a strategy like this, which is rare, I'm looking to short-term capitalize on volatility increasing. If the VIX goes up, all options increase in value. That holds true for both calls and for puts. So the goal is to buy both a call and a put at the same strike 1 or 2 weeks out, but hold the position only for a day or 2 days to see if volatility increases. 2 reasons I'm going to do this. Reason number 1 is buying a call and a put when the price is near the option strike price is better because the vega of the option or the sensitivity to volatility is very high. So if volatility increases, you're going to be making money on the call and the put. Even if the stock goes in one direction, that put will still go up and that call will still go up. Now, second, that vega or sensitivity to volatility declines as the option gets close to expiration, which is why I would only do this trade for 24 to 48 hour period at most to capitalize on a short-term trend in the volatility going higher. Also, as VIX rises, this gives opportunities to significantly increase your portfolio with small option strategies. I made a video on 5xing your money with a few cheap option trading strategies that you can check out right here.